right, let's talk markets ahead of a big week. Investors paying close attention to fighting between Israel and Iran, as well as the Fed. The central bank's going to be issuing its latest interest rate decision on Wednesday. And right now we want to bring in Lori Calvasina. She is head of U.S. equity strategy at RBC Capital Markets. And Lori, we thought we had a little bit of idea of how the markets were headed. We've been looking at inflation coming down. We thought maybe that was going to help the Fed get to the point where they might be able to cut rates. And then you saw what happened Friday with oil prices. How does that change the scenario?
So, look, what our economists have said is that the oil price spike, if we end up getting sort of a sustained move, could cloud the inflation outlook, could muddy the waters a little bit there. I will say as a house, RBC rate strategy and econ have not been expecting the Fed to move anyway until September. They think there's just not enough data out there to justify, either from the labor side or the inflation side, to justify a move. So I would say in terms of our own house view, no big change in our calculus. But we came into this year saying there was a lot of fog in the outlook, and it felt like that fog was starting to dissipate with some of this good news around tariffs. And now it feels like the geopolitics are making that fog thicken just a little bit more.
Yeah, we'd seen a shift in sentiment, not just from consumers, from investors, from businesses as well. And now maybe people are getting a little more cautious again.
Right. And that's something we said in our weekly that we put out this morning. There are a couple different things we're looking at in this situation in the Middle East. Obviously, all eyes are on oil prices. But what I'm really curious to see is that if you look at NFIB, if you look at the corporate surveys, if you look at the consumer sentiment surveys, if you look at AAII, sentiment has been inflecting, in some cases very strongly. In some cases, it's just very, very early days. So when we have a situation like this, how is that going to impact all these different sentiment gauges we're seeing? Because that real inflection in sentiment has been doing a lot to power this market lately.
And what does that leave you in terms of the advice you'd give investors at this point? We've come back to where the market, the S&P is less than 3% from an all-time high.
And look, I will tell you, my sentiment modeling says there's more room to go. My valuation, earnings, and GDP modeling says we're a little bit over our skis. So there's a wide range of outcomes that are legitimate at this point. I know people hate it when forecasters say that, but that is the honest truth here. As I sort of look down the road, what we're thinking about is not just that sentiment impact, but the impact on potential valuations. I think one good motto that would have served a lot of people well this year is hope for the best and prepare for the worst. And so what we do want to be doing is thinking about if things escalate here, if we do see a sustained oil price spike, if we do get a bit broadening out of this conflict, what can you do with your portfolio? So things like energy and materials tend to outperform when oil prices is rising. We spent some time looking at this over the weekend, and I was actually surprised to see it's not just the consumer discretionary sector that gets hit. It's also the communication services sector, which has been, kind of a big kind of core chunk of this growth trade that people have been heavily invested in recent years. It's a sector I like.
Why communication services? Why would it get hit by oil prices?
If you think about communication services, and I'm gonna nerd out here for just a minute, way back, a lot of these industries and stocks used to actually be in the consumer discretionary sector, and GICS had a carve out and kind of combined telecom with all these kind of techie things. It was sort of after we had that big ramp up in the internet space. And so a lot of that stuff got pulled out, things like media, entertainment. We saw a number of internet type names also moved from tech. And so it's kind of this weird sector now that's got a little bit of defense in it, but a lot of consumer oriented stuff just more on the tech side.
Consumer-oriented stuff, meaning if you're paying for streaming services and oil prices go up and you don't have as much left over after you fill your tank, you're going to cut one of them?
Exactly. And, I think it's somewhere between consumer staples and consumer discretionary. Consumer discretionary is the real, kind of riskier, cyclical stuff. Under, a lot of threat right now because of tariffs, frankly. Communication services is more durable in the consumer wallet, but not quite as defensive as what you see in consumer staples.
You read the headlines of what's coming out of the Middle East, and it's some pretty scary stuff. It's hard to even think about all the other stuff we're talking about with context to that, in relationship to that.
I think that's fair. And if you look at corporate earnings transcripts, companies have already been talking about geopolitics in a bigger way. We've seen that really ramp up. And if you look at some of the consumer company commentary from earlier this year, they were talking about fire, they were talking about weather, all these little discrete events, airplane crashes, things that might have not have affected people directly, but were showing up in spending by feeding into more cautious behavior under the surface. You have to wonder if that's going to come back here as well.
I'm just even talking about a spread of the conflict at this point, too. We have seen pullbacks in the past. When it gets to an October 7th event, there's something along those lines. What would you anticipate if you were to see an expansion in the fighting that we've seen to this point?
So if we kind of go through our 4 tiers of fear, the first tier, garden variety pullback, 5 to 10%. Frankly, a number of episodes around this particular conflict have been associated with 5% drawdowns. But if you sort of want to think about things really getting worse, and this is where we kind of go into hope for the best but prepare for the worst, I could easily see if recession, that word starts to get used. Remember, we've got some residual impacts from tariffs that are probably going to show up in data soon. If this contributes to that in some way and we start using the R word again, I could easily see a retest of the April lows. I also ran through one of my models this weekend. So I have this valuation model that lets me play around with rates, 10-year yields, and inflation assumptions. And I said, well, let me just keep the 10-year yield where it is. I'm going to give the Fed 2 cuts instead of the 3 we're forecasting. And I'm just going to take PCE. That's the inflation gauge we use, up to 4%. I just made up the number. I didn't get that from anybody.
Yeah.
They said, let me get a big, ugly number. Threw it into the model, looked at anything from flat earnings on the S&P this year to the current consensus, which is about 264. That gives me a range of fair value for the S&P of 4,800 to 5,200, which is right in line with a growth scare low and kind of retesting that April low. That's what's keeping me up at night right now. But Becky, if you want to really make things look bad in the modeling, right, just go back and look at what we call the 3rd tier of fear, which is recession or war pricing. If I look at things like the Russian invasion of Ukraine, the invasion of Afghanistan post 9/11, and the Iraq wars, those were all recession pricing in the U.S. ranging from 20 to 34%. I'm not going there, but again, we think that when things get uncertain, you need to go back and look at the history books.
It's like stress testing for the Fed with banks.
Exactly.
Yeah.